markets, right, I'll increase my position size by maybe 2 to 3R or 2 to 3x, sorry, not R, 2 to 3x. Okay. And so what that will do is, though my risk to reward is still the same, the dollar value will increase for those 2 months. But then afterwards, let's say after those 2 months, we go back. For example, what has it been, a month on QQQ?
Yeah, month. So last month on QQQ, right, in March, it was strictly just consolidating, right? After we hit all-time highs, right? The period to trade the options was the move towards all-time highs, right? The past 6 months of 2023 and a couple of months in January and February, right? Those were the hot periods for trading options, right? Because you had clear targets, right? That all-time highs level. There's a lot of liquidity resting above most names, right? For the tech names wise, right? AMD, NVIDIA, right? The whole play was to trade towards that all-time highs. So once we had that all-time highs hit on the QQQs, what happens, right? We went from expanding towards that all-time highs. The next logical thing is we're going to start consolidating. So, right, in that consolidation period, that's when a lot of people start getting the markets because they're like, oh, QQQ's at all-time highs. The market's starting to heat up. They try and come in, and then it's consolidating. And then when you're day trading wise, right, when you're trying to day trade and the higher time frames are consolidating, you're going to lose a lot of money, right? So that's where a lot of people, you have to understand market conditions as well, right? Back in February, I had my second biggest month in trading, which was I made $47,000, and every single trade I was taking live. And out of the 2 trades, right, 2 trades out of all the trades that I took that month, right? 2 trades made up for half of my P&L. So I took one trade on...
Even though the risk reward was fixed, it was the dollar amount.
Yeah, exactly.
The risk
right?
in.
The risk in, right? So NVIDIA, I took one trade on NVIDIA, one trade on AMD. It was on back-to-back weeks. Those 2 days, I made $26,000 out of $47,000 in total. And that 2 days made up for 50% of my P&L because those were those A-plus setups. And it only takes 1 to 2 good A-plus setups to make your whole month and potentially to make your whole quarter.
So with that being said, why would you not just only take your A-plus setups, knowing that counts for the most, and then you maybe disqualify a lot of the losses along the way for the other types of setups you have?
That happens, right? You mainly want to be sticking to A-plus setups, but obviously, as Rafay said, when sometimes you have a room, and Tony. Sometimes when you have a room, right, a lot of people, right, what do they like? They like day trading, right? They have to come into the game. They want to take trades every single day, right? So sometimes when you put on trades, they're not always going to be A-plus setups because the A-plus setups come once a week, maybe once every 2 weeks, right? Those A-plus setups, right? But a lot of people every single day, they're expecting A-plus setups every single day. You're not going to get A-plus setups when the markets are either consolidating or the higher time frame's not there, right? So
do you trade many? Do you trade, not currency? What's the word? Stocks? How many stocks do you allow yourself to trade?
So this is a rule I changed recently, just based off back testing. I used to primarily, I'd say 70 to 80% of my trades, and it's similar to what he just said, right, was Tesla. Why? Because Tesla was on the higher time frame. It's been uptrending for a very long time. So why would I not trade Tesla, right? For the past 2-3 years, Tesla's just been uptrending. That was my main primary stock. Off the Tesla stock alone on options, I probably made $1 million so far, off Tesla. Right? Why? Because it's been uptrending, the easiest stock to trade. But now Tesla's not uptrending. Tesla's been in consolidation, right? And therefore now I've changed the rule where I'm only looking for those higher time frame stocks. So usually per day we probably have 4 to 5 stocks on watch, but it's the exact same ones, right? So NVIDIA, Tesla, Apple, Meta, SPY, QQQ. 5 to 6.
On those 5, how often will you get a good setup? In the space of a week, how often can you execute on a trade?
So last week, for example, I took 3 trades.
Is that normal, or is that
on average? I only take like 1 to 2. Now in the option space, not a lot of people can say that they take 1 to 2 quality trades. Most people will take a lot, but for me personally, I take 1 to 2 per day. But recently, it's been 1 trade. So last week I did 3 trades. The week before that, I did like 4 trades. So it's been about 1 to maybe not even a trade a day.
And is it the same that people don't? In your space, I'm not a fan of the lower time frame, the M1, or is it quite accepted that people do it?
I think on the thing with options is, I don't know. I feel like
it's based off momentum, right? When the higher time frames are trending, right, that 1 minute time frame is going to be your guide, right? When you're consolidating, right, let's say the higher time frames, they're not really doing too much, right? You really want to stick on the 5 minute, right? Because there's less volatility, there's less liquidity in the markets. So what's usually going to develop is on the higher time frame, which is the 5 minute, right? But when the markets are trending, right, those 1 minute time frames, moves happen right off the gates, right? When you're looking at some of the best setups come from those opening drive plays, right, where you have a trending day the previous day, and then you come into the pre-market, right, it's consolidating, right? We're looking for that quick push towards the downside, and those happen right off the gates, right? Those usually happen on the 1 minute time frame.
Okay.
I was just gonna add on to that. What I was gonna say was, in general, in trading in general, not even in options, but in trading in general, nobody likes a lower time frame, especially newer traders, right? They're always like on the lower time frame. They're like, oh, it's a little bit too risky, like it moves
makes
too
sense,
fast, right?
yeah,
So
yeah.
even in options, like we're trading stocks, right? At the same time, we're trading this underlying stock as well. So they don't like the lower time frame. Most people, right? But if you can learn the lower time frame and then you can actually like go sit down, back test, and then also forward test while you're at it, right? Then you'll actually learn that the precision in the 1 minute time frame is the best precision you can have. Under the 1 minute, I'm not a big fan of like the, under that it's like 30. People are trading on the 30-second.
yeah,
That's
it
too
is.
much. That's too much.
Yeah,
But the 1 minute, I feel like is the last one, like the lowest time frame you should be on, and it's the most precision you can have. Definitely.
So when it comes to the 1 minute actual execution, is it just like a break retest or break of structure and coming back to the order block, or what is the actual entry and stop loss defined by?
Sure. So it's going to be, so let's say on the higher time frame level, we have a key level at like 100. Okay. On that 100, we break it on the higher time frame and we make a pivot high for the day. Okay. So once we actually retest on that key level, there's usually going to be something else, like you said, like an order block or fair value gap. We personally like those concepts. Like we don't really use that in trading options.
Does SMC or ICT bleed over into options?
They do like order
a little
blocks
bit,
wise,
yeah.
right? Fair value gaps, not so much, but order blocks, they're in every
Very
single
little
asset
though
class.
compared to your side of the industry. Very little SMC or ICT usually.
Okay.
This is mostly price action. But yeah, when it comes back to that key level, right? Technically, for most likely, like you guys will call it an order block, right? So it'll come back into that order block. You want to see buyers stepping in there. So for me personally, like the price action candles, like I need to see that the price action there, right? Buyers are stepping in, and I'm looking at those candlesticks, right? Like a lot of people will look at time and sales. They'll look at level 2 data, but for me, it's just too much noise. A lot of people will also nowadays I've seen people add the order flow. Right, people are adding order flow.
Can you see real orders in the market?
Yeah, you can see the order flow,
that's
right?
sick, that's sick, okay.
But for me, like personally, like I just like to look at the charts because I've tried all of that. Like when I was first starting out, I tried every single variable. Let me look at time and sales. Let me look at level 2. Let me add order flow into my strategy because
why is order flow not a big one? Because if I had that in Forex, I know it'd be super powerful for me, but we just don't. So then I have to see the footprints and the signs of it in price action to assess what the liquidity and orders are. But you have it. Do you use it a lot?
So I try to add it, but for me, it's too much noise because when you're entering on the 1 minute time frame, if you're also looking at making sure that the order flow is coming in, I'll look at the order flow on the higher time frame, right? Like look at the order. By what I mean by that
validate the zone
is exactly in that zone. Like, are people buying, for example, Tesla? Are buyers actually stepping in on the higher time frames and putting in big orders? Yes, that means the higher time frame will go up if the actual higher time frame chart is good as well, right?
Can you see resting pending orders or stop losses? Also,
no, you can
if
just
you have
active.
level 2. Yeah,
if you have level 2, but that's not order. That's not the order flow though. That's level 2. Yeah.
I would have said that would have been very powerful if you had that.
That's level 2.
Okay, so this is bringing to the next point I have, which we maybe don't see eye to eye on, is that your strategy is pending around trend on high time frame. I like it. High time frame zones, I like it. But then it's a consolidation, break, retest, lower time frame rejection, and then trade with that trend. If I'm to summarize very briefly. What I've also found is when you have a range of a type, whether that's a trend line, whether that's a support resistance, or anything that invites a lot of orders and stop losses, it could just be a structure point, because we know a lot of people are going to put their stop loss around structure. When I see these orders, a lot of people will say, okay, when it's broken that range, then it's a new trend. We've seen that push out, we've seen that injection of volume. But there's also the argument of it could be a liquidity grab. We go up, we grab those stop losses to fuel the move in the opposite direction. How do you differentiate between a break, retest, new trend going up versus push out, so liquidity grab, and go lower because you are breaking out of the range where the liquidity is? How do you decipher those two or differentiate those two?
Yeah, so basically what we're always trading is like momentum, right?